Good morning, and welcome to your weekend market briefing. I'm Jim, the CEO of the Alpha Group, and over the next few minutes, we'll walk through what moved markets over the last 24 hours and why it matters as we head into a new week. U.S. stocks finished the week on a strong note, with major indexes pushing higher. Bond yields steadied after a volatile stretch. The U.S. dollar held near recent levels, and cryptocurrencies showed signs of stabilization following recent pullbacks. Overall, markets are signaling cautious optimism, balanced by uncertainty around interest rates, inflation, and economic growth. Let's start with the biggest story. The Dow Jones Industrial Average closed above 50,000 for the first time in history. That milestone reflects broad investor confidence, driven largely by strength in technology stocks and renewed expectations that interest rates may decline later this year. Investors responded positively to solid corporate earnings and continued investment in artificial intelligence and productivity-driven growth. While record highs often make headlines, they also raise an important question. Does a strong market mean lower risk? Not necessarily. When markets move higher quickly, valuations become more sensitive to changes in economic data or monetary policy. For everyday investors, this milestone is less about bragging rights and more about understanding that optimism is already priced in. The second major story centers on the Federal Reserve. Over the past day, Federal Reserve officials signaled a cautious but evolving stance on interest rates. San Francisco Fed President Mary Daly acknowledged that the labor market is showing signs of strain, leaving room for potential rate cuts if inflation continues to cool. At the same time, she emphasized that the Fed is not rushing any decisions and remains data-dependent. Meanwhile, Vice Chair Philip Jefferson expressed measured optimism about the economy, noting that growth is expected to continue at a modest pace while the job market stabilizes and inflation gradually moves closer to the Fed's 2% target. For consumers, this matters because interest rate policy affects mortgage rates, auto loans, credit cards, and savings yields. For investors, it shapes everything from stock valuations to bond prices. Markets are currently reacting less to what the Fed has done and more to what it might do and when. Right now, the message from policymakers is clear. Rate cuts are possible but not guaranteed, and future economic data will determine the pace. The third story involves risk assets, particularly cryptocurrencies. After a volatile stretch earlier in the week, Bitcoin rebounded above key levels as equity markets strengthened and concerns over aggressive monetary tightening eased. Crypto markets tend to move alongside broader risk appetite, and the recent bounce suggests investors are regaining confidence, at least temporarily. However, cryptocurrency remains one of the most volatile asset classes. Sharp moves in either direction are common, especially when expectations around interest rates or liquidity shift. For investors, crypto continues to act less like a currency and more like a high-risk, sentiment-driven asset. Taken together, these three stories point to one central theme. Markets are operating on expectations, not certainty. Stocks are climbing because investors believe interest rates will eventually come down. The Federal Reserve is signaling flexibility, but refuses to commit to a timeline. And risk assets are responding quickly to shifts in sentiment rather than fundamentals alone. The practical takeaway for everyday investors is discipline. This is not a market that rewards emotional decisions. When markets reach record highs, it's tempting to chase performance. When volatility returns, it's tempting to pull back entirely. Historically, both reactions tend to hurt long-term results. Instead, diversification, patience, and attention to economic data remain the most reliable strategies. Inflation readings, labor reports, and consumer spending numbers in the coming weeks will have an outsized influence on market direction, especially as investors try to anticipate the Fed's next move. As we head into the new week, expect markets to remain sensitive, responsive, and at times unpredictable. That's the environment we're in. optimistic but cautious. That's your weekend market briefing. Thanks for spending a few minutes with us today. Enjoy the rest of your weekend. Stay informed, and we'll be back soon with the next update as new data and developments emerge. And if you like this content and want to continue to be updated on financial news and markets, don't forget to like and subscribe.